Good afternoon or possibly good morning where you're listening to our webinar today. But I want to thank everybody for logging in today to our webinar featuring a guest presenter today. We have a special guest, the wealth manager, Kirk Chisholm, who's going to join us in just a few minutes to talk about alternative investment strategies. And a lot of the webinars we present here at Advanta, we talk more about maybe about specific investments, investing into real estate or tax liens or making private notes and mortgages a part of your IRA portfolio. Today we're going to step back a little bit and take more of a different view and get the perspective of somebody who has been in the financial industry for a number of years and is rare in the sense that he incorporates self-directed IRAs and alternative investments as part of his planning and part of his techniques he uses with a lot of his clients. That's not something you see with a lot of different wealth managers and financial advisors. So we're happy to have Kirk Chisholm joining us here today, and he'll be on in just a few minutes to kind of go over just some general questions and some general strategies when investing. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years now. Those of you who listen to our webinars regularly have heard me many times, or if you come to some of our live seminars, you've seen me present as well. So I've been with the company for a number of years, initially handling a lot of the transactions, people buying and selling alternative assets within their IRA account. I handled that for many years, but spent my last probably 5 to 7 years really focusing more on the business development aspect of Advanta IRA, helping really inform more people about self-directed IRAs and what's really possible and things you can do with your retirement accounts that you didn't know was even available to you. Now, at Advanta, we serve clients nationwide. We have 2 offices. One is in Atlanta, one is in Tampa, in the Tampa Bay area. But we have clients who work all over the country. We're not bound geographically at all by whoever we work with. And we really strive to provide really superior customer service to all of our clients. We have account managers who get assigned to each particular client that comes to Advanta, so that when it's time to make an investment or you have questions regarding your account, you have that one point of contact in talking with someone. You're not calling the 800 number waiting to get essentially the next person who's going to be able to, the next available representative on 800 number. So you have that personal contact. We currently have over about 5,400 active accounts, getting close to $1 billion of assets under management. And again, we have a lot of experience in the industry. We've been around since 2004. My background is I'm an attorney. Our owner is also an attorney and a certified financial planner, although we don't do that planning or that legal work for any of our Advanta clients. We are big proponents at Advanta of education, and as such, we really devoted a lot of time and energy and resources in developing really the right learning center and the right learning environment and different programs like the one you're listening to today. We have seminars. We have live seminars in our office in Atlanta and Tampa. We do webinars like the one you're listening to today. Frequently, we do usually have probably 1 webinar or so a week. Sometimes it's just talking about general self-directed IRAs, things that we do internally. But as we're doing today, we like to also bring on guests to talk about different types of investments as well and share their expertise. So that's why we have Kirk on with us today. We do have this webinar is being recorded, so those of you who are listening live will be able to give you the playback if you want to go back and listen to a certain part again. If you're listening to it on a recording, and you're already at our Advanta On Demand channel on YouTube. So we house all of our recorded webinars on YouTube. So if you ever miss out on a webinar that you would like to attend but it just doesn't fit in your schedule, you can always go back to our YouTube page and catch that at a little bit later date. We also try to provide a blog with a lot of, again, updated information, whether it's regarding the new tax laws, other aspects of self-directed IRAs, tax liens, et cetera. We try to put that information into our blog and make that available to you as well. Now, if you're listening live today, if you have questions during the webinar, you can type those questions into the chat box. Either myself or Kirk can address it. So if it's a self-directed IRA question, maybe that's something I would handle. If you have a question about something Kirk talks about, you can certainly type that question in and we'll get to it. We just caution you again, Kirk is a wealth manager, a financial advisor. Please no questions on specific investments on whether or not they're a good idea. He certainly does not have the information to even begin to analyze that type of investment. If you have a general planning or retirement portfolio question, please just type those into the chat box, and hopefully we'll have some time at the end to get to them. Now, a lot of people haven't heard of self-directed IRAs, and a lot of you on this call obviously have, but outside of those who are already in the know, most people aren't familiar with self-direction simply because most self-directed or most IRA custodians are banks or their brokerage firms that offer their clients limited investments. You can invest in only those products, only those particular investments that they sell. They don't allow for their clients to invest into a wide variety of different things as you come to see with a self-directed IRA. So a lot of people don't even know it's possible. It's not a matter of they're choosing not to self-direct. They simply don't know that the ability to use your IRA to invest in something outside the market is even possible. So that's why we exist at Advanta IRA, is we hold those alternative assets, whether you're buying a real estate rental, a real estate flip, you're doing some private lending out of your IRA, tax liens, private placements, just so many different things you can do. And I would encourage you to go to our learning center or contact us possibly if you have specific questions on those types of investments and how it works. But today's webinar really is about bringing on a guest who's going to share some of his information, some of his guidance and expertise when it comes to wealth management and kind of just in general getting a retirement portfolio going. So our guest today is Kirk Chisholm. He is with Innovative Advisory Group. And again, what I think is really great about Kirk and why we wanted to have him come on as a guest is that he is part of a company that does provide strategies that include both your kind of traditional or conventional investments, but also he is open and believes it can be a good idea for many people to and also incorporate those alternative investments. And I think that's what lets him stand apart a little bit from some of his contemporaries in the financial planning field. Kirk, are you there?
Yep, I'm here, Scott.
All right, good. Oh, good. Kirk, well, again, thank you for coming on today and sharing your expertise with us. I guess kind of to kick us off, like I said, you do traditional and alternative investments, but how were you first introduced to self-directed IRA accounts?
Yeah, thanks. So it's actually an interesting story. So I've been an investment advisor for over 18 years. And I used to work on the broker-dealer channel at the wirehouses and in the beginning of my career. And I had a client actually call me up and tell me, they said, hey, I want to invest in this private mortgage. It's getting 16%. He started telling me about it. I said, well, that's really interesting. He said, well, I want to do it in my IRA. And my first thought is, well, I don't know if you can do that. And he's like, no, I'm pretty sure you can. So I went and asked my manager. I said, oh, is this what a client wants to do? Can I do it? He said, no, you can't do it. And he's like, no, I'm pretty sure you can. He's like, well, you can do it, but we can't do it. Then the light bulb went off, and in the wirehouse channel, they don't teach you this stuff because they're not making money off it. So I wasn't getting paid on it, but I worked with my client to go through the process and help him figure out what he needed to know. So, this is early 2000s, so the internet wasn't what it is today. So it was really hard to find information online about self-directed IRAs and how they work. And it took me a good 4 or 5 months to figure this whole thing out. And I helped my client through it, and it was really, really interesting. And it really kind of light bulb went off in my head as to, wow, this is a great opportunity that no one is taking advantage of. And so I explored it more in the subsequent years, and I think it was around 2007, 2008. Actually, it was 2008 when we started our firm, Innovative Advisory Group. And one of the reasons was we wanted to be able to provide alternative investments inside of retirement accounts to our clients, which in the traditional sense of our profession, people just don't do. Partially because they don't understand how the process works, and also partially because it's not scalable in the traditional way you would buy a stock bond or a mutual fund. So it's really been an interesting journey, and I'm glad we did it because there's really no one else in our field that does what we do. And, as you said, Scott, there's not as many people know about self-directed IRAs and what they can do. I think there's maybe I think right now is maybe about 5% of IRAs are in alternatives, and based on our research, I would say no more than 10% of the IRA investors are even aware they can invest in alternatives. So, some of this is an educational process, but we've really enjoyed working in this space because it allows us to do a lot of things that we've wanted to do. I know we can get to some of that in the additional the questions, but it's really been great for us. It's allowed us to expand our services and investment services for clients that we can offer things outside of the traditional box of stocks, bonds, and mutual funds.
Yeah, and I think that's interesting. So it's kind of you found out about the way a lot of people do is maybe somebody brought it to your attention, and you again, same kind of thing. You don't think it's even possible because it's not something you'd heard about, but you asked the right questions and then saw a good opportunity. Kind of next question, we have some some general planning questions, and maybe we'll get into some more on specific self-directed IRAs. But when individuals are, again, with a lot of the self-directed individuals specifically, they are, in a sense, already taken that direction of looking out for themselves for their own retirement. They haven't, a lot of them have made the comment to me that they have taken it upon themselves to go out and find investments because they don't necessarily trust an advisor that they're currently working with or have worked with. But if an individual is trying to do a lot of things on their own, or just not getting advice, what's the number one mistake that you think that individuals make when they're planning for or considering their retirement and what they want to have available to them going forward?
Well, with that question, it depends how much time you have. There are a ton of mistakes that people make. I guess I'll take the question in a different tack. So, you could talk about from a numbers perspective. I know there's a GAO study done, I think, a year or two ago, which showed that I think it was 41% of households between 55 and 64 years of age have zero retirement savings. None. So that's kind of a scary thought. And I think, obviously, looking at that statistics, there are a lot of mistakes people make. But I would say the one thing that we do a lot of work on with our clients, which probably has the most impact, because anybody can run numbers. There's a lot of online calculators and things like that. But one of the things that we work with our clients on, one of the biggest mistakes is this. When people retire, they go through, we don't even like using the word retire. We just call it phase 2. When you're retiring, you're really changing from the working mindset of, spending your days working to spending your days doing nothing. And I think one of the biggest mistakes people make is they don't plan for what they're going to do in retirement. They just think they're going to sit in the beach or, sit in front of a TV all day. And if you want to die quick, that's a really good way to die quick. When people go from 100 miles an hour of working every day to not working, that has huge impacts on people when they retire. And we find that one of the most important things people can do is actually to, plan for what they're going to do, try something new, but they need to stay mentally engaged in that kind of phase 2 of their life. They could have, 10 to 40 years left in their life. And it's important that people really focus on the things that, are important, whether that's, learning an instrument or an art, or maybe it's they continue working. It's keeping them mentally engaged is one of the most important things. And I think that is overlooked by a lot of people in that process of retirement. So when we're working with clients, more work is spent on the other aspects than people might think, because I think they're overlooking that, and most of the articles and whatever that people read are all about the numbers and how much money they need to save. All of that's important, or I should say all of that's necessary. But the important stuff is really, the quality of life that you're going to have when you retire. And I think that's one of the biggest mistakes people make, is ignoring that piece of the puzzle.
Yeah, that stat you said was the 41%. That's certainly scary, but I think that's an excellent point, though. You do see, I think the famous football coach, was it Bear Bryant, that when he coached for so many years at Alabama, and once he retired, I think he died within a year. And that's kind of helps illustrate what you were just talking about. And certainly, I think that's definitely something most people probably don't think about. They think, I'm just going to sit at home, or I'm going to do this, or I'm going to go spend more time with the grandkids or whatnot, and they don't really factor in all that extra time that they have and the impacts that would have on them. The next question, kind of, in a more general sense of planning, what types of strategies or how do you work with clients to really protect their portfolio from outside factors? And I'm, again, preface this with saying, again, I'm certain each individual, their age, their different demographic factors, things are going to vary a little bit. But in general, what are some things that you do to help protect a portfolio from factors really outside of an individual's control, whether that's tax changes? We saw the recent tax law just passed. Obviously, that's going to impact some people here and there. You have inflation. You have global events, that people have no control over as well. What kind of things do you do or encourage individuals to do to really protect their portfolio from those types of events?
Yeah, thanks. So I think that one of the more overlooked concepts of portfolio management, investing, any sort of planning is risk management. And I think part of this is human nature. We're all built to survive in certain ways. Our instincts are based on things that helped us thousands or tens of thousands of years ago, and watching out for the tiger that's going to eat us. And some of those instincts work against us in today's in kind of the society we live in today. And unfortunately, there's some very common things that people do that work against them. FOMO, or fear of missing out, is a huge problem in that area. But one of the things that's pertinent to this is the fact that people only focus on the returns. They're focused on how much they can make. How much can I make in this investment? And the risk management barely even comes into the conversation. So we have a concept that we work with, which is, risk management first, which is, when we're looking at any investment, we're looking at risk management before we look at what the performance is going to be. Because the performance will take care of itself. Either it works out or it doesn't. The challenge is, how do you manage the risk of your investments to minimize that as much as possible? So we look at risk management as, how can we mitigate as many of the risks as possible, and then whatever's left over, you're either comfortable with those risks or you're not. So, you can't mitigate all the risks because there's risks in everything. You can look at U.S. Treasuries, which are supposedly a quote-unquote risk-free investment. Everybody in the investment community agrees it's the risk-free rate, as they call it. So, you can use the word guarantee and all that around treasuries because it's as risk-free as you can find in the world of investing. However, it's not risk-free. It's possible the U.S. government could default on debt. It's highly unlikely, but it's possible. So you have to acknowledge the fact that this is a risk. It's a very low probability risk, but it exists. So when we're analyzing investments, we're not looking at, well, that's never going to happen. These things do happen. Fraud happens. It's funny. We had a good, interesting conversation with our regulators a number of years back about alternative investments. And they were, our industry does not use alternative investments in the same way as they use traditional. So they look at alternatives and say, well, alternatives are risky. Well, I would argue they're no more risky than traditional investments. So our conversation we had with them is, we'll say, well, what's risky? Is a real estate investment that you can touch and feel and is registered in the registry of deeds, is that risky? Or is AIG or Bear Stearns or Lehman Brothers, are they risky? You can't look at an investment as it's a security, it's less risky, and it's an alternative, it's more risky. You have to look at the investment in and of itself individually. So we look at every investment individually and say, is this a good or bad investment? What are the risks involved in this investment? And if there are risks we're uncomfortable with and we can't mitigate, then we don't go with it. You know, I mean, if you're investing in something you don't know, then your risks are higher than if you're investing in something you're an expert in. So if you've never done anything associated with real estate in your life, and now all of a sudden you're going to decide you're going to be a real estate investor, there's a higher risk there than if you rehab properties for a living. You know, if you do that, you probably know the ins and outs, you know the contractors, you know the people, and it doesn't matter what investment it is. I mean, we've worked with people who invest in horses, real estate, you know, payday title loans, private company stock, tax liens, you name it. And they all come with different risks. And what's important is that people understand the risks and they mitigate them. So if you look at, I mean, the alternatives are all different, so it'd be hard to generalize that. But if you look at like traditional investments, I'll give you an example on the traditional investment side. Doing your research. I mean, all these companies provide annual reports, quarterly reports, you know what the numbers are. They could lie, they could be fraudulent like some of these financial companies in 2007 and 8 were. But, you know, at the end of the day, you can mitigate some of those. Some people do it through options. You know, some people look at options as risky, but options are actually created to manage risk. So we run some portfolios, you know, hedging them with options. So we know exactly what the maximum risk is to the downside, and we know what the upside potential is. That is a clearly defined risk. It doesn't mean it's right or wrong. It means that you can clearly define it and you know what the risks are. Either you're comfortable or you're not. If you are, then it makes sense. If you're not, then, you know, we find something else that does. So that's an example in the traditional markets. In the alternative space, maybe you manage risk by buying insurance on something. So, you know, on real estate, buying insurance on it, or buying insurance on a horse, or, you know, there's different ways to manage risk. But I think the key point is just to understand that there are risks in any sort of investing, in any sort of portfolio, and how you deal with it. So other than that, I mean, there's things like you mentioned, tax changes, inflation, global events. Unfortunately, our society is becoming increasingly complex. And it may have always been complex, but it seems like it's speeding up because the flow of information is quicker. So you look at these bigger macro events. I mean, we spend a lot of time assessing these bigger trends and macro risks, things that you have absolutely no control over. And, you know, we assess that. I honestly don't know how individual investors do it. I mean, it's a full-time job for us, and we don't have enough time to do it all. Like, it's just so much information you need to assess. But, you know, at the end of the day, there are some things that change, and there are some things that don't. I mean, you know, you look at the tax changes that just went past. I mean, it was a big revamp, but did things change that much? Overall, not really. I mean, it did in many ways, but you know, going from our current tax situation to a flat tax would be a big change, and that's something that, you know. But I think you have to understand the fact that you're going to be paying taxes most likely on something. You know, that is a part of investing. If it's in an IRA and you do it right, then there probably won't be a tax on it, you know, which is obviously a part of what we're talking about here. So that's a huge benefit of using IRAs, and I think it's probably a low probability that they're going to, you know, do away with the tax code that allows you to have IRAs and tax deferred or tax-free growth with Roth IRAs. So you have to kind of assess this in the best way you can. But I find that one of the best ways to do that is to just invest in what you know, invest in what you're an expert at. If you're an expert in real estate, don't invest in horses. You know, if Peter Lynch was famous for this quote of saying, investing in what you know. He said it in a somewhat different context, but you know, the underlying principle holds true. You know, if you invest in what you know, you'll tend to do better, and your risks will tend to be understood better than if you're just investing in other investments to diversify. Because I believe diversification is important, but not just for the sake of diversification. You have to do it in the right way. So, I think that's kind of how I would look at those risks and how to protect your portfolio. I think those are some general strategies that people can employ.
Yeah, and I guess you've probably, and this is the next question I have up on the screen, I think you kind of already touched on it, but kind of what an individual needs to recognize about themselves to kind of figure out whether they want to be a little more conservative, be a little more of a risk taker. But that is what you were just saying. I mean, really investing in what you know, key to this concept as well about whether or not you're a conservative individual or you're a risk taker. How much does that play into it? Because, again, I think that, again, that's important, and that's what we hear people who self-direct, a lot of individuals, and I'm sure you've heard as well, they are looking at a self-directed IRA because, as you said, they are a real estate investor already personally. They feel like that makes sense for them then to use their IRA to buy a rental property because they can understand, they can price a rental property, they understand the returns. That to them makes more sense than stocks. So is it something about an individual, again, they need to look at within themselves and really have a heart-to-heart with themselves on understanding what they really know and what they don't know that helps determine how they really, what kind of investor they end up being?
Yeah, and this is actually a really hard concept for most people, and I'll explain why. So when we work with our clients, we go through a risk questionnaire to assess what an individual's risk tolerance is. I think it's an industry standard. It's honestly, it's part of our requirements and regulatory requirements. But from a deeper level, we can do that. We can have somebody say, this is what my risk tolerance is. But one of the challenges that I face, because, I kind of take this to the next level, is how do you assess somebody's risk tolerance based on what they're not saying? Because everybody will say, well, I have a high risk tolerance. I'm an aggressive investor, or I'm conservative. What I find fascinating is the people who say, well, I'm really aggressive. I want 5% a year. Or, I'm really conservative. I only want 15% returns a year. Well, there's a huge disconnect for what is typical and what people are expecting. So there's, that's one piece of it, is people don't tend to have a good grasp on their own risk tolerance. They might think they do, but they really don't. And I even went through a period of this earlier in my career where I thought, I could take high risk. And I realized, I'm not really a high risk. I mean, I have a high risk tolerance, but I'm not looking to take crazy risks. Not to say that I'm not comfortable with it. I am, but I think people confuse two ways. So one, they confuse what their actual risk tolerance is, which is a big problem. Another is they're confusing risk with return. So what a lot of people will say, well, I want more return, so I should take more risk. I don't believe that's the best way to look at it, because why would you ever want to lose 50% of your money? I mean, in 2008, from the peak of 2007 to the bottom of 2009, more or less, most equity markets are down about 50%. Who wants to lose 50% of their money just because they're taking more risk? I think that's absurd. But that's our new investing reality. And in real estate, obviously, some places did much worse. Some places not so much. But I think a lot of people are confusing with taking more risk with better returns. And that's not necessarily the case. I look at it and say, how can we take the least amount of risk possible and get the best returns? Because I don't think it makes sense for anybody to lose 50% of their money. And a mathematical concept which I think escapes a lot of people, they might understand it, but on the surface they don't think this way. They think, well, I lost 20% of my money. All I need to make is 20% to get back to where I was. Well, that's not how the math works. Let's say you lose 50% of your money. You need to make 100% to get back to where you started. The math does not work the same way. So, it's kind of the concept of leverage. It works both ways. Everybody loves it in the upside, but it works, the other way in the downside. So there's kind of this this running joke of, what do you call an investment that's down 90%? Well, it's an investment that was down 80% and then lost 50% of its value. Like, it's just, when you run numbers, it's just it's really scary when you lose money. So that I think the core concept, and Warren Buffett talks about this, is it's really important not to lose money because it's really hard to make it back. Unfortunately, most investors don't think in those terms. I mean, I talked about this earlier. Most investors think in the terms of how can I make the most money possible? And the S&P is going up. Why didn't I make 20% last year? Why I should have made 30. Why didn't I make more? Like, it's always about, making the returns, and they have no concept of risk. And there's a whole generation of investors and professionals on Wall Street that have been working in the industry for the last 10 years who've never experienced a bear market. They just think that things always go up. And that is also a scary concept. So I think there's a huge disconnect between the understanding of risk and what that means. I mean, there are ways that you can take very low risk and make decent returns. I'll give you an example. Like, when I first started looking at tax liens, 15 years ago, it was one of my more favorite investments, and we can talk about these investments later, but it's one of my more favorite investments because it was a very low risk. If you do moderate amount of due diligence, it's very low risk. And the returns are double-digit yields. Florida, you can get 16, 18%. Now, the yields have been compressed a lot in the last 10 years, but but the risk was, the way I assessed it, was very low in general, not specific to any one, but in general, the overall risks were low. So that was a huge disconnect for return and risk. And you can find those things. I mean, tax liens are one example, but you can find real estate properties, private company stock. I mean, you can find good investments everywhere if you look hard enough. But you have to look. So I think that concept is something that people need to understand, the connection between risk and reward. And they also need to understand, and I'll bring in the traditional markets for this example because I think this is a very good one, and I'll give you my own personal experience. So as an investor, everybody is subject to their own internal psychology. So everybody's different. You have your own, you have your human nature, which everybody operates under similar biases, and then you have your individual biases. So for myself, I realize that because everybody has this, even the best and the brightest in Wall Street have this same problem. So don't think that you're better or worse than anybody else. Everybody has this problem. The idea is you have to understand yourself and your own psychology and where your weaknesses are and where your strengths are. Everybody has them. I have them. You have them. Warren Buffett has them. Everybody has them. You have to understand your own strengths and weaknesses. And once you can understand what those are, you can find ways to address those. So I'll give you an example. When it comes to buying and selling stocks, there's always this concept of when do you sell? Where do you put in stop losses? That's fine, but it's hard to do that these days because Wall Street will seek out your stop losses and trigger them and that whole thing. So you have to find ways to address that. And my issue that I was having was, well, how do I deal with stop losses? Because if it goes down, if the stock goes down, well, I feel, well, maybe I'll let it go a little more and then a little more. And this is very common. A lot of people have this problem where they don't want to sell because it'll just come back. Even though I know full well that I need to sell, you rationalize with it as it's happening, thinking, oh, well, what if this happens? What if this happens? So I know that's a weakness of mine. Not everybody has this weakness, but it's mine. So I've addressed it in a different way. So I use options as a way to manage that risk. So for options, I use, instead of having a stop loss, I have an option. Well, an option, the stock could go down 100%, but I have a capped loss at, let's say, 5 or 7%. And that's the most I'll lose, no matter where the stock goes. And if the stock happens to come back, then I potentially could profit. So it's a way for me to address my own internal issues with another way of investing. This is me. Some people do it other ways, but what I've done is I've realized my weakness and what my strengths are, and I've changed my investing style around those strengths and weaknesses. So each of you have to come to like a self-realization of what those strengths and weaknesses are. And I know, a lot of people think that, no, I'm fine, I'm perfect, I know, what I know. I have a friend who day trades for a living. He's been doing this for 10 years. He's making, ridiculous returns on his money, but he's only investing his own money. He's very successful. And every single day he shows up to do his investing or trading, he has to fight an internal battle with his own internal psychology of understanding what his weaknesses are and trying to overcome those with his investing style. And he tells me all the time, he's like, every day it's a new battle. Like, you have to fight your own. You're basically in a battle with yourself, and because computers can do this and they don't have the same problems, but we as human beings have this human nature and psychological biases that we have to overcome. And doing that requires that we understand ourselves. So I think that is one of the biggest realizations any investor can make, is understanding themselves and taking a lot of time to reflect on what their tolerance for risk is. Because if you really don't have a tolerance for risk, then you should not be investing in high risk things. So hopefully that addresses that question. But you could go on for hours on this topic. There's science behind all of this, but it's a very important thing that people understand on a very basic level, so they can, if they want to be better investors, then they really should be assessing that internally.
Okay, yeah, and that's again, I think that I've heard that before from individuals that I want to move some money over, but my account went down last month, so once I see that recover, then I'll make a move. And I've seen that so many times over the years of people having that same issue that you mentioned, of that psychology. So I think that's probably a very common one that is out there. You mentioned tax liens as one of your favorite alternative investments. We're going to switch gears a little bit here and talk more about the self-directed aspect, and get your thoughts on these assets, and hopefully get through a couple questions here before we run out of time. But what else do you have as kind of what are some of your other favorite alternative investments? And then leading into that, what kind of individuals do you see that are typically drawn to or express that interest in self-directing their retirement account?
Sure. Yeah. So as I said, tax liens are, clearly my favorite for many reasons. Just from the low risk and the high yield that people are getting. I think right now, one thing that everybody on this webinar is probably realizing is that assets across the board are expensive. It really doesn't matter what you're investing in. Stocks are expensive, bonds are expensive, real estate's expensive. There are pockets of value here and there, but as a general concept, most assets are expensive. And if you think your asset isn't expensive, then you probably are not aware of what's going on. I have people telling me, well, private equity, there's still great deals in private equity. Yeah, private equity is really expensive right now, as a general asset class. And I think the challenge is because there's so much money printed, and we could go on a tirade of all the problems in our financial system, but the challenge is there's so much money floating around out there, and it's chasing assets. And not just here. Central banks across the world are buying assets to manipulate the prices. So when people talk about are central banks manipulating, gold or real estate or any of this, yes. They've admitted to this. The Swiss National Bank owns 4% of Apple or something crazy like that. It's absurdity. So you have all of this money pushing asset prices up. And that makes it really challenging for investors to find good deals. So what I'm finding is, obviously, if you have a niche that you're doing well in and you have a beat on, whether it's real estate or horses or whatever it may be, that's great, and you should stick to that. But as an asset, I love real estate. I think it is, for many reasons, one of the better asset classes out there. You've got tax benefits, you've got, recurring income from it. You can add value to it. I mean, there's so many advantages to real estate in my mind, except for one. Real estate is more or less tied to inflation. So as long as we have inflation, real estate will be fine. But if we experience what Japan experienced, which is deflation, I would advise you to, I've written a few articles on this. I'd advise you to look at the statistics for Japanese real estate. It has gone down for over 10 years. And think about how that works. I mean, real estate's great because you can leverage it. You're getting, let's say on a residential property, getting 5-to-1 leverage. With a mortgage, you're able to leverage and get more for less. One of the other advantages of real estate. That is all great as long as we have inflation, but if we have deflation, that concept works in reverse. Your rents are going to be lower, your asset price is going to be lower, you're going to be your equity will run through in a matter of time, so you'll be upside down in your mortgage. Like, there are a lot of negative things that can happen if inflation turns negative. Now, we're not in danger of that right now. There was some talk of that in the last few years, of that potentially being a problem, and it could be a problem in the future. It's not right now, in my opinion, or at least based on the statistics. But that's an issue. So one thing that I like private mortgages, because effectively you're getting real estate without tying up your capital. So you don't have to tie up your capital in a property. You don't have to invest in, CapEx expenditures, new roofs, new toilets. You don't have to worry about, tenants not paying their rent. You're basically loaning money off real estate. So you have the same real estate asset. As long as you price it right, then that's a risk that you can be comfortable with. And if you get a good yield, then that's a return you can get comfortable with. And we're seeing pretty decent yields right now for private mortgages. So that I really like as an asset, because if we have deflation, then I'm not tying my money up. Most of these private mortgages are, let's say, 1 to 2 years, so they're short term. So if the market changes, the economy changes, I can put my money to work relatively quickly. So I really like that as an asset class. I think there are a lot of real estate related investments that I like. I mean, most of them are real estate related. I've seen some interesting ones. And I think most of these are probably not for the broad masses, but I've seen some interesting ones. I had a client who invested in payday and title loans, which I thought was if you can get, I mean, you can basically get these enormous returns from these loans. I mean, it's not like you're doing God's work by any means. You're mainly a loan shark is what you are, but but just from a numbers perspective, the risk to return is quite decent. But that's not something for everybody. So it's just, I found it to be an interesting asset, and more interesting that this is even allowed. But yeah, I think that, I've seen a lot of interesting assets, oil and gas properties. I've seen farmland is, in my mind, a really interesting one. It's pretty cheap right now, and it's certainly it's been in a downtrend for a while. But I think there's enormous value that can be had, and I think that a turnaround in farmland is probably not far off, at least from everybody I've spoken to, and I've spoken to some institutional experts on this. So that's interesting to me for many reasons, similarly to real estate. So in real estate, that's one of the few sectors I really like. But yeah, I mean, there's a number of really good assets. I mean, I think we put together a list of 75 alternatives that people can check out. Domain names is interesting. Domain name URLs, it's like a frontier asset class that nobody knows anything about, but there's been a huge boom in that for the last few years, especially with Asian money coming in. You have to really understand it, but I know some people that do really well at it. Obviously, cryptocurrencies is really interesting, and that's caught everybody's attention. I think there's it's probably got too many people's attention right now. But I'll briefly talk about that one because I think that's extremely interesting. And this gets into a risk management topic, so it'll kind of tie it into our other conversation. Cryptocurrencies use Bitcoin, for example, and forget what it did in the last month or two. But even let's just take the earlier last year. I mean, we liked it as an investment earlier last year. And it's the kind of investment that Wall Street loves, not because of what it is, but because of what it represents. Wall Street, or most investors, look for what we call an asymmetric risk investment or trade. And what that means is asymmetric is one-sided. So you have, let's just say, the Bitcoin's a perfect example of this. So Bitcoin could go up 20 to 100 times your original investment. It's possible, and some people theorize it's very probable. On the other hand, it could go to zero. So if you look at it from that perspective, you're getting, let's say, 10x upside and 1 downside. So you invest $100, you lose $100, or you make $1,000, or whatever it ends up being. That's what we call an asymmetric risk trade. Now, hedge funds do this. They're looking for like 3 to 1, return to risk ratio. This is a more obvious version. So I like it from that perspective. I think it definitely has potential upside, but you have to acknowledge the fact it could very easily go to zero for many reasons. Or if not zero, it could go down a lot. And I think if you look at it in that context, then you can be comfortable with the outcome. Because if it goes to zero, it's, you put a small amount of money in it, like 1% of your portfolio or some small amount. But if it goes up 20 times, you just made 20%, on your whole portfolio from this 1% investment. So I think it's an interesting, cryptocurrency is a very interesting asset class right now. It's got a lot of people's attention. It's still new in the self-directed IRA arena, so a lot of people are trying to figure out the logistics of it because it's a very new interest. Also because as an asset class, there's a lot of friction involved. So what I call friction is it's basically a hurdle. So if you want to buy a stock, there's no friction. You just open an account, deposit money, click a button, you're done. There's almost no friction on that. The friction is basically opening your account. Cryptocurrency is a lot of friction. So you have to figure out how it works because most people don't understand how they work. You have to figure out how you're going to, you have to open an account. Where do you open an account? Where do you hold your coins? How do you keep them secure? How do you trade them, exchange them? Like all these different things. These are all new. It's not like a bank account. There's multiple steps in the process. You have to keep it safe. There's a lot of things involved. And for many people, there's too much friction. It's too much to deal with. I'm not going to buy it. So there's a very small segment of the population that's even investing in these things because of the amount of friction involved in figuring it out. I mean, I've tried to do this, and it's taken me days to figure out how to even open up accounts and secure it. If you want to do it right, it takes you some time. You can certainly do it and take a lot of risk and potentially do it wrong. But to do it right, you want to make sure you dot all the I's and cross all the T's. So that's a very interesting asset class. I know, Scott, you mentioned you're going to have somebody talking about that asset class, in an upcoming webinar. But I find it fascinating, just from what it represents, not the underlying investment itself, because I think everybody's got an opinion on it. But I think what it represents is truly fascinating.
Yeah, we have a webinar coming up. It's going to be next Tuesday at noon. We have somewhat of a crypto expert to talk about it. But yeah, as you've talked about, there's definitely some hurdles involved, and he's going to hopefully address some of those during that webinar, so everybody can tune into that. I want to skip ahead. I know we're running out of time here. Get a couple of questions. I think one specifically that I think is important to everyone, regardless of what they're investing in, whether it's a rental property, a tax lien, cryptocurrency, a private equity. But one of the things I know that your firm is big on, obviously, the risk management, and with that comes due diligence. And how can an individual really be sure, or to the best degree of certainty they have, make sure they're performing the proper due diligence on an investment, especially when it comes to something that's alternative. And maybe some of this expands back into the traditional marketplace. But for alternatives, how does someone really make sure they're doing due diligence on what they're buying?
Yeah, and that's a great question. The due diligence is an art, not a science. And I think that what makes it especially challenging is it's hard enough to do as it is, and most people are not experienced in it. So, and I think this gets back to my earlier point of people not doing any risk management and not focusing on it. So what I see a lot, we get a lot of calls from people calling in saying, hey, I saw this podcast with this individual who's got this great fund and they're investing in mobile home and trailer park properties and the returns seem great and I want to invest in it. It's like, well, what are the risks? They're like, I don't know. Well, you know what the risks are. Why are you doing it? Like you're just throwing why not just go to the casino and throw your money on red or black? I mean, you get better odds there. And I think one of the challenges is figuring out where things could go wrong. So when you're doing due diligence, it's important to figure out where things could go wrong. What are all the different things? So if you look at all the mistakes people have made, all of the court cases, the frauds, I mean, if you want to learn, that's what you do. I mean, you go through and look at all these things and why did people make this mistake? Bernie Madoff, why did people make this mistake? Well, that one was simple. They trusted somebody because of his background, and when he gave them friction, they just said, oh, it's okay. He basically put on the air of, well, that's fine. You're not going to be a client anymore. And he's guaranteeing, quote unquote, guaranteeing people like 10% a year, which institutions ate up. So people are like, no, it's okay. I don't want to irritate the guy. I don't want to, him not to manage my money. So people were caught up in that allure of return over risk. And, there's only a handful of people that actually did the due diligence on him. I mean, Harry Markopoulos, who happens to be a local guy in Boston, did that because he couldn't figure out how he was doing it. And we've come across frauds before, and we're in some cases limited to what we can say because of our regulations. But we've come across frauds before. And, we've talked to the people, and they're like, oh, we want to get some clients in this. And I say, well, you're not doing this, you're not doing this. And their answers are mind-blowing. It's like, oh, we don't need to do that. Like, I'm pretty sure in the regulations you're required to register this investment. No, we're not going to do that. Okay, well, you're not going to get our money, right? It's that simple. Like you have to check the boxes in many of these things. But even if you check the boxes, it's more than that. We get 20 to 40 calls a week from investment sponsors that want us to provide their unbelievable investment to our clients. I mean, most of those go right in the trash. It's just there are so many out there that I could just take 5 minutes and discount based on what they're doing. Now, I'll give you a good example. I've had 2 people contact me over the last few months that had this similar issue. One person was starting up a biotech company or a biotech fund, if you will. And everybody in the fund didn't have any fund experience. They had biotech experience, industry experience. So basically I knew what they were doing. They were realizing, hey, we could make so much more money from creating a fund and investing in our buddies' projects, and we can make money off it, and everybody does well. And I could tell right away these guys had no idea what they're doing. And they were just out to raise money, which everybody is doing right now. I'm seeing a plethora of requests to raise money from people who are totally unqualified. So I asked them a simple question. I said, how much of your personal money is going into this? They're like, well, we don't have enough, we don't have a lot now, but this fund is going to be great, and they just sidestepped the question. I said, well, why aren't you investing your own money? If you have somebody who truly believes in what they're doing, they have a vast majority of their money invested in their own stuff. I mean, there's an investment advisor I know on the West Coast who is a quant. He's a phenomenal guy, really bright. good friends with him. He has, I think, 75-80% of his money in his own funds. I mean, he has a bunch of ETFs, and he does them on a quantitative method. They're it's just basically algorithms that are running them. He has vast majority of his money, and the rest of his money is in like real estate. So it's not money he could invest anyway. So that's an example of a simple question you could ask of, are you investing your own money in this? And some people might lie to you, but most people will be honest and just say, well, why not? And I think it's just asking questions, digging, asking the questions of lining up incentives and trying to figure out where people might try to, mess you over for whatever their investment is. And it just goes back to identifying risk. So due diligence is not something simple. There's nothing I could explain to you in less than like 5 hours, but it's something that's important for people to do. They need to, if there's not someone they know that can do it for them, they need to research how to do it well, and really just identify all the weak points in the process of where somebody could more or less screw you over. I think and it's not always deliberate. It's like a contract with a business partner. A lot of people go into a business with a partner thinking that everything's going to be roses, and they're not thinking about what could go wrong. But something always goes wrong. It may not end the partnership, but you always have disagreements. And if you don't put things in writing, those verbal agreements tend to somehow dissipate over time. People forget, or just deliberately forget that conversation happened. So it's just about having everything in writing, understanding what could go wrong, trying to mitigate what those risks are. You can, in many cases, negotiate with the other party on some of these risks. So it's a lot of what we do. We do a lot of due diligence, but it does require a lot more effort on your part as an investor to actually do it well. So I highly advise it. I think it'll save you a lot of grief and loss in investments. But I know it's challenging. It's challenging for us, and we do it for a living. So, but I think it's necessary.
No, and I think that's a great answer, because countless times I've sat with people, and then sometimes everything works out fantastically for them. But you hear someone talking about an investment they have, and all they're talking about is all the upside. They never mention, here's all the upside, but actually I just got to make sure this doesn't happen or that doesn't happen because that's the downside. People just want to hear the good parts. They don't want to get into that. I think that's an excellent, so that's something that goes really across all asset classes. If you're buying real estate with a friend, or you're investing in different types of hedge funds or whatnot, you really to understand that is certainly key for due diligence. Last question, we'll let you go, Kirk, and then I think I want to make sure is there a way that anyone can get that? You said you had a list of the 75 or possible self-directed investments. Can they get that on your website?
Yeah. So what I'll do is so we have a we have a page on our website. If you go to innovativewealth.com give me half a second here. Let me look it up, make sure I got it correct. I don't want to send people off into the ether of the internet. So innovativewealth.com /Advanta IRA webinar, and that will take you there. And you'll have to give me about 10 minutes after this webinar, and I'll make sure it's live. I have to double check that, but that's what it's going to be.
Okay. But I guess in closing, you mentioned some oil and gas, by the way. What's some of the other more creative ways you've seen people use? What are some of we've seen some interesting things certainly here at Advanta from time to time. What's some of the more creative things you've seen people do? This is really interesting. Certainly, you look at like Mitt Romney, who's got like $100 million IRA. Which is crazy, right? You think about it, how is that even possible? Well, it's possible because he's a smart guy and he made good investments, which are obviously key points to this. But I think it requires more than that because even if you look at Warren Buffett, who's a good investor, I think anybody would argue, and over time, let's say he's making 20% returns. You can't build that kind of wealth
on those kind of returns. You need to, if you're putting in $18,000 a year and getting 20% returns, you're not going to make $100 million. Like, it's just mathematically not probable. So there has to be a little something extra. There has to be that special sauce that's in the mix. And I'll give you an example of how somebody used this, and hopefully people on the webinar can take this and come up with other creative ways that they can enhance or juice their returns. So one example is, I came across a real estate investor many years back, and what he was doing was, he's a real estate investor, very knowledgeable. But what he did a few times a year is he would flip properties. So he'd find a property, let's say it was worth $100,000. He would lock up a contract for $50,000, and he would flip it to somebody for $75,000. And so he would make $25,000 on his investment. But the key is, he would put up $1,000 deposit on the contract, or $100, whatever it is, but something insignificant. So he's putting down $1,000. He's making $25,000. He's making 25x his return. Now, that method may not be scalable for everybody, because what he was doing on a smaller scale, I mean, you can't do this. If you do this type of transaction too many times, you could potentially get taxed in your retirement account, which is a whole other topic. But what people need to think about is, how can I juice my returns? How can I take a little money and turn it into a lot? So I know there's a lot of people who've tried to do this, and if you do it, a handful of times with some really big on a big scale, it's certainly possible. So I think what Mitt Romney was doing was different. I mean, he doesn't talk about what he did, but more or less, I think what he did was similar to this concept. Buying private company stock for pennies, letting it grow to dollars, and using a lot of money, which obviously scaled up. I mean, if you look at Peter Thiel, Max Levinson, they both have, I believe, 100 million plus IRAs because they invested in technology companies. I think Peter Thiel invested in Facebook at pennies a share in his Roth IRA. So you can imagine how big his Roth IRA is right now. That's another example of how people can be creative with it. I can't give you the details, but I know of this one IRA, which is interesting. So there's a GAO study done about 4 or 5 years ago on IRAs, and they call them like the big. I forget the name of the study, but it was basically a study on big IRAs. I think there are 413 IRAs in excess of $25 million. So out of all the IRAs, there are 413 in excess of $25 million. The interesting part of that stat is not that. The interesting part of the stat is that the average of those 413 people is the median amount is $257 million. So
wow.
Think about the numbers.
So you don't have a bunch of people at like 26 or 27 million. You have quite a bit more.
Right. Well, not only that, but if you think about, Mitt Romney, Peter Thiel, Max Levinson, I mean, they may have more in their IRAs now, but at the time of the study, let's say they were at 100 million. Well, the average is 257. So think of what the upside is that's balancing that out. Now, I know there is at least one individual who has investment over $1 billion in their IRA. So I have heard that rumor from a few professionals. But if you think about it, there's got to be more than one of those people because
right.
It's just to average it out at that 257. So I guess the point is they didn't get there by being without being creative. And if people listen to this webinar probably have a lot of creativity in them anyway if they're thinking about self-directed IRAs, because the concept itself is not traditional. It's not run-of-the-mill. You have to be able to think outside the box enough to want to do this. It's not different. It's just the mindset of somebody to do this. In the West Coast, self-directed IRAs are huge. In the Northeast, where I am, I mean, we're all old Yankees up here. We're more, fiscally conservative. people look at the concept and they say, I don't know about that. That seems a little weird. So you have to have the right kind of mindset to do it anyway. But if you have that mindset, most likely you're going to be able to come up with some really cool and creative investment strategies that will allow you to leverage up a little money into a lot just by using a traditional transaction like the real estate guy I was telling you about. Like, all he did, he was doing the same thing he always does. He just took a little money and turned it into a lot. You just have to find a way to do that at a scale that makes sense for each of you as an investor. And I've seen this example happen time and time again. And I'll give you one parting example, which I think is interesting because I happen to know the guy. He's a local friend here, but there's a thing called the DISCs or DISC transaction. I don't fully understand. It's complicated. It has to do with importing, exporting, or I don't know, international commissions or some crazy stuff. But the point being is this was something that his accountant came up with. His accountant took this tax code, this piece of the tax code, and used it with a Roth IRA. And this is all public records. There's court cases for this, so I'm not disclosing anything private. But his accountant did this. It was all legal. It was all above board. And he did this very creative transaction, which allowed him to put a few $1,000s and turn it into millions of dollars in his Roth IRA, all because his accountant was obviously very smart to do this. But the DISCs are not a common thing anyway. But what he did was he took what they were already doing and used creativity to create, a multi-million-dollar Roth IRA for himself. And, the court cases have to do with, the IRS not liking the concept. It's allowed. I think he's won on appeal, but the point is the IRS just said, well, it shouldn't be allowed. Their argument wasn't it's not allowed, it shouldn't be allowed. Well, then rewrite the tax code, but and that's an extreme case, but I guess the message I want to convey is that a lot of this is creativity. I mean, we are very creative. I mean, you can see it in the name of our firm, Innovative Advisory Group. We're very creative in how we address things, because I think that one of the fun parts that I like about self-directed IRAs, and one of the things that really initially drew me into it, was the creativity that it allows you to do. Whether it's real estate or tax liens or horses or whatever it is, there's so many options you can invest in with your retirement account. I mean, there's only a few restrictions. You're virtually unlimited on what you can invest in. So, if you understand it enough and put some time and thought into how you can use this concept individually, I think you'll have outstanding results if you put enough thought into how to construct it in a way that you take advantage of it in the best way possible.
Yeah, Kirk, great ending point there, and some great examples I think to help really illustrate all the concepts that you talked about today. And to everyone that's listening, I think you've really benefited. You had Kirk on here for about basically an hour or so talking about things you don't hear a lot of other financial advisors talking about, because Kirk is open to and obviously incorporating self-directed IRAs as part of what he does, and also probably a lot of what his clients do as well. Kirk mentioned you can go to innovativewealth.com/Advanta IRA webinar. Give him a little bit of time after the webinar to get that list of 75 of the different self-directed IRA investments. Kirk, before we leave, what's another good way for people to get a hold of you if they want to get some more information?
Yeah, so we have a great website we created for people who are do-it-yourselfers who want to learn more about self-directed IRAs. We just created resources for people to help themselves. But that's all for free. That's stuff we give away. I'm an investment advisor, so I work with individuals and certainly service professionals, attorneys, accountants, and helping people with doing this. We actually work with other financial advisors too, because most of them don't know how to do this. But yeah, the best way to reach us if you want to talk to us about some personal investment or about a client or what have you, you can either call us, or if you go on our website, innovativewealth.com/contact. You can just shoot us a message through that contact system, and we'll reach out to you and we connect that way. So those are the two methods that you can reach us best.
Okay, all right, good. Kirk, again, thank you very much for your time, some excellent information. I'm sure everybody that was participating live has learned a lot. Those of you who are watching the recorded version of this at a later date, certainly reach out to Kirk with any other questions you have. So again, thank you very much for coming along.
Hey, thanks for having me on, Scott. This was a lot of fun.
All right, thank you.